In 22 of America's 100 largest cities, owning a home costs at least 50% more per month than renting. Not 10% more, not 20, 50% more. The average homeowner with a mortgage pays around $2,035 a month on housing costs. The average renter pays $1,487. That is a $548 gap every single month in favor of renting. And yet, buying is almost certainly still the right decision for most people watching this video. Both of those things are true at the same time. And by the end of this video, you will understand exactly why. Here is the problem with the rent versus buy debate in 2026. Most of the advice you will find online was written for a world where mortgage rates were 3%. That world is gone. And the financial maths has changed so dramatically that advice from even 3 or 4 years ago can actively lead you to the wrong decision today. Here is the specific problem. At a 3% mortgage rate, a $300,000 home had a monthly principal and interest payment of around $1,265. At today's rate of 6.5%, that exact same $300,000 home costs $1,897 a month. Same house, $632 more every month for 30 years. And on top of that, the median home price is now $429,300. The income you need to qualify for that home at today's rates is $111,000 a year. The national median household income, $106,800. When keep American families are right at the edge of what the maths allows. This is not a lecture, it's a reality check. And the advice they are getting, whether to rent or buy, is too often generic, too often outdated, and too often wrong for their specific situation. This video is the honest answer. 4 things. 1. The real monthly cost comparison of renting versus buying in 2026. Every number you need, side by side. 2. The hidden costs of both options that almost nobody factors in. 3. The one number that determines whether buying makes financial sense for you personally, and most people have never heard of it. And 4. The 5-question framework that gives you a clear, specific, honest answer for your situation. Let's go. Section 1. The real monthly cost comparison. Let's use a real 2026 scenario. Median home price, $429,300. 20% down payment, $85,860. Loan amount, $343,440. Rate, 6.5%. Monthly principal and interest, $2,170. Property taxes at 1.2%, approximately $429. Home insurance, approximately $150. Maintenance, and this is the one most people skip. Industry standard is 1% of home value per year. On a $429,000 home, that is $357 a month. This is the cost most people forget. Total monthly cost of owning, approximately $3,100. Now renting. The national median rent is currently $1,379 per month. That is a $1,700 monthly gap in favor of renting. Annual gap, approximately $20,652 in favor of renting. But before you close this video and never think about buying again, that number is only half the story. Because renting has a cost that does not show up in the monthly payment. and it is the most important number in this entire debate. Section 2. The hidden costs of both options. Hidden cost of buying. Closing costs. On a $429,000 home, closing costs typically run 2 to 5%. That is $8,000 to $21,000 out of pocket on day one, before you make a single mortgage payment. This is money you do not get back if you sell in the short term, which is exactly why your timeline matters so much, and we will come back to that. Hidden cost of renting. This is the more surprising one. Zero equity and rising rent. Every mortgage payment builds equity. Every rent payment builds your landlord's equity. That is not a metaphor. It is literally what is happening every month. And rents are not staying flat. Redfin forecasts rents rising 2 to 3% annually through 2026. On a $1,379 rent, that is $27 to $41 extra dollars every year. Compounded over 10 years with no equity gained, you have paid significantly more than your original rent and own exactly nothing. Meanwhile, the homeowner who bought at 6.5%, in year one, approximately 42% of their mortgage payment goes to principal, actual equity. By year 5, that percentage increases. And if home prices appreciate even modestly at 2% annually on a $429,000 home, that is $8,580 in equity growth per year from appreciation alone. This is the payoff of buying. Section 3. The price-to-rent ratio. The one number most people have never heard of. The price-to-rent ratio compares the cost of buying a home to the cost of renting a similar one. You calculate it by dividing the home purchase price by the annual rent of a comparable property. Here is how to read it. Under 15, buying is clearly the better financial decision. 15 to 20, it depends on your situation. Above 20, renting almost certainly makes more financial sense. Let's run it for our median U.S. scenario. Home price, $429,300. Annual rent for a comparable property at $1,379 a month, $16,548. Price-to-rent ratio, 26. By this measure alone, renting wins nationally in 2026. But, and this is where the honest answer gets more complex, the national average hides enormous variation. This is the nuance that changes the answer. In Indianapolis, the price-to-rent ratio is 14. Buying wins clearly. In Austin, it is 19. It depends. In San Francisco, it is 37. Renting wins by a landslide. The price-to-rent ratio for your specific city, in your specific neighborhood, is the single most important number in your rent versus buy decision. You can calculate it in 5 minutes with a quick search, and it will immediately tell you which direction the maths points in your market. Section 4. The 5-question decision framework. Question 1. How long are you planning to stay? The break-even point in 2026, the number of years you need to stay in a home for buying to beat renting financially, is typically 4 to 6 years at current rates. Under 3 years, rent. 5 or more years, buying becomes increasingly compelling. The closing costs you paid on day 1 start to be absorbed by the equity you have built. Question 2. What is your debt-to-income ratio? This is the one most people ignore until a lender tells them they don't qualify. Add up all your monthly debt payments, car, student loans, minimum credit card payments, and divide by your gross monthly income. If that number is above 43%, most conventional lenders will not approve your mortgage. Know this number before you start shopping for homes. Question 3. What is the price-to-rent ratio in your specific city? We just covered this. Under 15, lean toward buying. Above 20, lean toward renting. Between 15 and 20, use the other questions to decide. Question 4. Do you have a 20% down payment plus closing costs plus a full emergency fund? This is where most first-time buyers underestimate the capital required. On a $429,000 home, 20% down is $85,000. Closing costs add another $8,000 to $20,000, and you still need 3 to 6 months of living expenses in reserve for emergencies, because the moment you own a home, things break. Everyone who has owned a home recognizes this. If buying drains your emergency fund, you are not ready. Question 5. The final question, the most important one. Can you actually afford the full monthly cost, not just the mortgage payment? Banks will tell you what you qualify for. That is not the same as what you can comfortably afford. The industry rule is that your total housing cost, mortgage, taxes, insurance, maintenance, should not exceed 28 to 30% of your gross monthly income. On the median U.S. home at current rates, that requires a household income of approximately $132,000 per year just to stay within that guideline. If the maths works, buy. If it doesn't, renting while you build toward a stronger financial position is not failure. It is strategy. The 5-question framework. 1. Will you stay 5+ years? If no, then rent. 2. Is your DTI below 43%? If no, then not ready to buy. 3. Is your local price-to-rent ratio below 20? If yes, then buying leans financial. 4. Do you have 20% down plus closing costs plus emergency fund? If no, then not ready. 5. Is total housing cost under 28 to 30% of gross income? If yes, here is the honest answer. The one nobody gives you. Renting is cheaper month to month in most U.S. markets right now. By a significant margin. If you are staying under 3 years, if your local price-to-rent ratio is above 20, if your DTI is too high, or if buying drains your emergency fund, rent. Protect your financial position and build toward buying from a stronger starting point. If you can answer yes to all 5 questions, you are ready. And at 6.5% rates with potential to refinance lower, the long-term wealth case for buying a home you plan to stay in for 5 or more years remains intact. Every month of equity you build is a month your landlord does not. The answer is not always buy or always rent. The answer is the 5 questions. Run them. Be honest with yourself and make the decision that the numbers support, not the one that feels good. If this gave you a clearer picture, hit subscribe. Every week on First Million Club, we break down exactly these kinds of decisions with real numbers. No filler, no hype. And next week, we are covering the 7 money habits that are quietly keeping most people from building wealth. And I promise you, at least 2 of them are going to hit uncomfortably close to home. That one drops next. I'll see you there.